Nigeria inflation data just came in. Ahead of the read, it was unclear to analysts how much of a further drop in price pressures will be revealed in the September data, or if we will see some level of stickiness. Nigeria September 2025 inflation rate slowed to 18.02% from 20.12% recorded in August 2025 and lower than most forecasts. Indeed, a steeper decline than seen in the previous month. This was also the softest reading since May 2022, mainly due to foreign exchange stability, harvest season, as well as base effects linked to the base year change earlier this year. On a month-on-month basis, the headline inflation rate stood at 0.72%, also lower than 0.74% in the previous month. Notably, food inflation also showed an improvement, recording a minus 1.57% month-on-month change compared to plus 0.74% the previous month. The decrease can be attributed to the rate of fall in the average prices of maize, grains, gari, beans, millet, potatoes, and other food items. Also, core inflation on a month-on-month basis was 1.42% in September compared to 1.43% the previous month. We have Mr. Opeyemi Agbaje, CEO, RTC Advisory Services and Chairman, PENCOM, to share insights on the latest inflation print. We also will be looking at the IMF World Bank annual meetings and the latest economic outlook, which continues to be tepid with rising downside risks. Hello, welcome to Global Business Insights, where we delve into the headlines and probe a little deeper with perspectives to help navigate the dynamic context.
The size of the drop in inflation this time is decent, is significant. Over a 2% drop in inflation. The month-on-month figures also went down by 0.72. So this time, and I think last month as well, the year-on-year is going down, and the month-on-month is also going down. So that's more robust in terms of the size of reduction in the increases in price levels. Food inflation is also down by 1.57, almost 2% as well, month on month. So that's good news. I think finally government may begin to celebrate the taming of inflation. We're down to 18%, 18.02%, approaching more decent levels, more acceptable levels. Of course, the objective should be to get inflation down to single digit, to below 10, 9 and below, and then we can celebrate. But from going near to 40% that we were dealing with just a short while ago, reducing it by updating our consumer price index, which is legitimate, I need to say, to reflect up-to-date pricing. But so by methodological measures, we reduced it significantly to the 20s, and now in substantive levels, substantive price levels have decreased. That validates the CBN decision to drop the monetary policy rate at the last MPC. It validates that decision. I recall that one or two analysts had questioned that decision. But in the end, this significant drop indeed reinforces a demand for more reductions in the monetary policy rate. I think we can expect another gradual reduction in the MPR, given that inflation is now 18%. And if this level of drop is sustained and we get to 14, 15 in another 2 months, that will be great news for the Nigerian economy. And then, but like I said, the objective should be getting inflation down to single digits so that interest rates can decline significantly. And then there will be an impact on consumption. There will be an impact on the cost of doing business and the cost of living, all of which will be positive for the citizens.
To our next deep dive, the International Monetary Fund Head of Research, Pierre de Gourinchas, yesterday said the global environment remains volatile and the temporary factors that boosted activity in the first half of 2025, like front-loading, are fading. Global growth was therefore projected to slow from 3.3% in 2024 to 3.2% in 2025 and 3.1% in 2026, with more advanced economies growing around 1.5% and emerging market and developing economies just above 4%. Inflation is expected to drop globally, though still above target in the United States.
Global growth is holding steady despite major policy shifts. The increase in tariffs and its effect has been smaller than expected so far. This is thanks to new trade deals, multiple exemptions, and the private sector's agility in rerouting supply chains. As a result, global growth is now projected at 3.2% this year and 3.1% next year, only a modest downgrade from last October. Yet, beneath the steady surface, complex forces are at work. Easy financial conditions and a weaker dollar, fiscal stimulus in some major countries, and surging artificial intelligence investment are all shaping activity and inflation dynamics. Risks remain tilted to the downside. The AI surge could trigger a sharp market correction if profit expectations do not materialize. Fiscal pressures are mounting across many countries and may interact with financial market fragilities to further raise borrowing costs and increase rollover risks. And institutional credibility, particularly central bank independence, faces growing political pressures that could de-anchor inflation expectations. Still, there are upside risks too: a faster resolution of trade tensions, an associated reduction in uncertainty, as well as the potential for significant productivity gains from AI, could all give global growth a meaningful boost.
We continue to observe unabating uncertainty, more protectionism, and labor supply shocks weighing on global activity. Also threatening macroeconomic stability are lingering fiscal vulnerabilities, potential financial market corrections, and the erosion of institutions with pressure on some of the major institutions like the central banks. So what has changed since the last forecast? Despite optimism about artificial intelligence-driven productivity gains, downside risks remain significant. The artificial intelligence momentum also implies there could be less resilient casualties and a possible break on the pace of investments, which could hurt the broader markets. There could also be good news if we see a more relaxed tariff environment as China and the US hopefully move to resolve differences. Also, more pressure on central banks to support sagging activity could be another driver of potential destabilization. For Africa, less trade concessions and less external aid, higher borrowing costs, and tighter fiscal space calls for adjustments to create more fiscal room. This could mean fresh focus on fiscal prudence and discipline. IMF, in their latest forecast, see Nigeria's GDP growth dropping from 4.1% in 2024 to 3.9% in 2025, hardly the take-off some were forecasting to see. Crude oil prices has WTI futures already under $60, which is below break-even for new shale wells and could be a problem for economies reliant on higher pricing for crude. To boost fiscal health in such economies, production volumes will have to go up significantly to make up for lower prices, reflecting the lackluster economic growth picture. Now to more business stories. America's biggest financial firms kicked off the third quarter earnings season with strong performance. Yesterday, JP Morgan Chase, Wells Fargo, Citigroup, and Goldman Sachs reported significantly higher quarterly profits, while BlackRock, the world's largest asset manager, announced a record $13 trillion in assets under management. All five firms beat analyst expectations for earnings per share. Banks have benefited from a rebound in mergers and acquisitions and revenue from volatile trading and all-time highs in the stock market. But analysts warn of rising bad debt exposure to low-income consumers and lower-rated corporate borrowers. There is also concern that equities have bubbled up and vulnerable to correction. Jerome Powell, speaking to the National Association for Business Economics conference in Philadelphia, says risks to America's labor market appear to have risen and suggested they outweigh those posed by inflation. The latest dot plot from the summary of economic projections signaled 2 more rate cuts this year. Investors expect the first 25 basis points rate cut when the FOMC have their meeting on the 28th and 29th of this month. Asia Pacific markets were mostly higher, unlike on Wall Street, where yesterday there were declines after US and China renewed their trade feud. Also just in, Bank of America beat estimates as it reported Q3 results on stronger than expected investment banking performance. Morgan Stanley also posted a massive third quarter beat. Strong earnings from the banks may now be overshadowing the US-China trade turmoil as Wall Street is today seeing stocks going up. Well, that's all we can take on this episode of Global Business Insights. This is Bodo Shosani. Thanks for watching. Bye-bye.